let me say something that will immediately reshape how you view investing. My name is Kevin O'Leary, and I did not accumulate my wealth by moving with the crowd. I built it by recognizing the right moments to take action, by identifying real value when others were panicking, and by maintaining the discipline to commit my capital with confidence. Today, I am going to reveal the 2 stocks I would purchase instantly, without delay, without hesitation, if I were placing new money into the market at this very moment. Before I explain the specifics, there is something I need you to do. If you are truly committed to growing your wealth, if you want to learn how to think like a serious investor rather than someone casually experimenting with their retirement savings, you need to subscribe to this channel right now. Press that button and become part of this community, because what I am about to share is not a quick profit gimmick. This is genuine money, proven strategy, and real-world results. I want to know that you are committed to this path. Now, let me give you some context. We are currently experiencing one of the most fascinating financial climates I have witnessed in my 4 decades of investing. People everywhere are running around in panic, stressed about inflation, anxious over interest rates, and fearful of a recession. And my response to all of that is simple: good. Let them worry. Because while others are frozen by fear, that is when investors like me create wealth. That is when the strongest opportunities appear. Fear is actually the greatest ally of a disciplined investor. Most individuals do not truly understand what investing really means. They treat it like gambling. They believe it depends on luck. But here is the truth: luck has nothing to do with it. Investing is about recognizing true value. It is about discovering businesses that consistently generate cash, maintain strong competitive advantages, and are led by management teams capable of delivering results. Most importantly, investing is about purchasing companies when their stock is undervalued, not when the crowd is hyped and prices are inflated. I've spent years on Shark Tank, reviewing thousands of businesses, and I've learned what makes a company truly succeed. I understand the factors that distinguish winners from losers. The 2 stocks I'm about to share with you possess all the qualities I look for. They have strong economic moats, consistent cash flow, reliable dividends, and management teams that are skilled at allocating capital efficiently. These are not speculative bets. They are not unproven tech startups claiming they will change the world but have yet to make a single dollar in profit. These are established companies with genuine earnings. Let me ask you something: when was the last time you carefully examined a balance sheet? When did you last calculate a company's price-to-earnings ratio? Or consider the power of dividend yield and how it compounds over time? Most people never do this. They simply buy what Jim Cramer recommends on TV, or follow some influencer online who is probably still living in their parents' basement. That is not investing, it's just noise. Today, I'm going to cut through all that noise. I'm going to provide the same analysis I would give my own family if they asked me where to invest their money. The truth is, I don't waste time on poor investments. My time is too valuable. Every dollar I put to work must generate returns. It must grow. If it doesn't, I sell it. That discipline is what separates the wealthy from everyone else. The foundation of my investment approach is simple: I am a dividend investor. I love dividends. I love cash flow. I love being paid while waiting for a stock's price to rise. Why? Because dividends are tangible, real money. You can't fake a dividend. A company that consistently pays dividends must have actual cash flowing into the business. They can't simply impress you with flashy charts projecting future growth, they have to deliver a real check to shareholders every quarter. That's accountability. That's tangible proof that the company's business model works. In today's uncertain and volatile markets, dividends act as a safety net. When the market drops 20%, and believe me, it will eventually, you're still receiving those dividend payments. You're still earning. And if you're wise, you reinvest those dividends, purchasing more shares while prices are depressed. That is how real wealth is built over time. That is the magic of compounding, what Albert Einstein reportedly called the 8th wonder of the world. Now, I know some of you are thinking, Kevin, dividend stocks are boring. I want fast gains. I want something that will double in 6 months. To that, I say, good luck. Go ahead and gamble, but don't call it investing. True investing is steady. True investing is disciplined. It's about generating consistent returns year after year. In wealth building, the tortoise always beats the hare. So, what am I looking for in these two stocks? First, pricing power. I want companies that can raise prices without losing customers. In an inflationary environment, that's essential. If a company cannot pass costs onto its clients, margins shrink, and the stock stagnates. Second, a strong balance sheet. I want minimal debt and ample cash reserves because tough times always come. The companies with solid financial foundations survive crises and emerge even stronger, while the weak ones go bankrupt. Third, a competitive advantage. I want a moat, a barrier that prevents competitors from stealing market share. This could be a beloved brand, a network effect, or economies of scale. Whatever the form, I need to see that the company has a unique edge that safeguards its profits. Fourth, I want a company that is reasonably valued. No matter how exceptional a business is, if I pay 50 times its earnings, I'm likely to lose money. Value matters. Price matters. You can own the best company in the world, but if you pay too much, you can still suffer significant losses. These are the principles that have guided me for decades. These are the rules that have made me wealthy. And these are the same principles I'm applying to the two stocks I'm about to share with you. But before I reveal them, you need to understand something: these selections are not for day traders. They are not for people who check their portfolios every few minutes. These are long-term investments. These are stocks you buy and hold for years because that's how real wealth is accumulated, not by constantly trading, not by trying to time the market, but by owning strong businesses over extended periods. I've been investing for 40 years. I've lived through multiple recessions, market crashes, booms, and busts. Through it all, the strategy that has consistently worked is owning quality companies with strong fundamentals and holding them through the noise. While everyone else panics and sells at the bottom, I hold, and often buy more. That's the difference between a true investor and a speculator. Now, let me introduce the first stock. I'm going to explain exactly why I love it, what makes it unique, and why I would invest in it immediately without hesitation. This is a company that most people overlook. It's not flashy or glamorous, but it generates substantial profits and pays me simply for owning it. The first stock I would purchase immediately is a company operating in the energy infrastructure sector. Now, before you dismiss this as some dull utility, let me explain why this is one of the smartest investments you could make right now. This company manages pipelines, storage facilities, and terminals that transport oil, natural gas, and other energy products throughout North America. Here's the brilliant part: they don't rely on the price of oil going up or down. They earn revenue based on the volume of energy transported. Essentially, they function as a toll booth on the energy highway. Consider that for a moment. Every single day, regardless of global events or political debates over green energy, people still need to heat their homes, factories still require natural gas to operate, trucks still consume diesel fuel, and all of that energy must be moved from point A to point B. That is where this company plays a crucial role. They own the infrastructure that makes all of it possible. And you can't just build a new pipeline overnight. Regulatory hurdles make new construction extremely difficult. That gives this company a massive competitive moat. Now, here's why I'm so enthusiastic about it. First, the cash flow is highly predictable. The company has long-term contracts with its clients, often spanning 20 to 30 years. These are not speculative, spot market deals where they are gambling on daily price fluctuations. These are secure, contracted revenues. Management knows exactly how much income to expect next quarter, next year, and even 5 years down the line. This predictability allows them to do something very valuable: pay a substantial dividend and grow it consistently over time. Currently, the dividend yield on this stock exceeds 6%. Let me repeat that: over 6%. Can you show me a savings account that pays 6%? Can you name a bond that offers 6% without taking on enormous credit risk? This is the kind of reliability and return that makes this stock extremely compelling. You won't find another opportunity like this. And this isn't some risky dividend that could be cut next quarter. This company has a long history of consistently paying dividends, increasing them multiple times over the years. It's shaping up to be a dividend aristocrat. But here's what makes it even more compelling: the valuation is extremely attractive. Investors are so focused on technology, artificial intelligence, and whatever the latest hot trend is that they have overlooked infrastructure companies like this one. The stock is currently trading at a substantial discount compared to its historical average. Its price-to-cash flow ratio is appealing, and the enterprise value relative to EBITDA is reasonable. In short, you're getting a high-quality business at a bargain price, and that is exactly the moment to back up the truck and buy. Here's what I do with a stock like this: I purchase it, hold it, collect the dividends, and reinvest those dividends to acquire even more shares. Then I let time work its magic. Over 5 years, over 10 years, your gains come not just from the stock price rising, but also from accumulating more shares through dividend reinvestment. Your position grows steadily, and your income stream expands alongside it. This is how real, generational wealth is created. Now, some skeptics might ask, Kevin, what about the shift to renewable energy? What about electric vehicles? Won't pipelines become obsolete? My response is simple: show me the numbers. Yes, the world is gradually moving toward cleaner energy, but this transition will take decades, not just a few years. Natural gas remains essential in this process because it burns cleaner than coal. And even if we were to electrify every vehicle tomorrow, which is unrealistic, we would still require massive amounts of energy to produce that electricity. The infrastructure this company owns will remain crucial for decades. In fact, here's something most people fail to realize. As we continue to expand renewable energy, the demand for natural gas plants grows because they provide essential backup power. Wind and solar are intermittent; you can't control when the wind blows or the sun shines, but natural gas plants are controllable. You can turn them on or off whenever needed. That makes natural gas even more crucial in a renewable energy future, not less. This company also holds another significant advantage: they are not sitting idle. They are actively investing in new infrastructure, increasing storage capacity, and expanding terminal operations. They are positioning themselves for the energy landscape of the future, whatever it may look like. Strong management doesn't remain static; they adapt, evolve, and find new ways to generate returns. That is precisely what this company is doing. Consider the numbers. Over the past decade, this company has consistently generated free cash flow. It has returned billions to shareholders through dividends and share buybacks. Debt levels are controlled, and it holds investment-grade credit ratings. This is not a speculative bet. It is a blue-chip infrastructure business trading at a discount simply because Wall Street is overlooking it. Here's my favorite part: when the market eventually recognizes the quality of this business, when dividend-focused investors start moving back into high-quality income stocks, this stock will re-rate higher. The valuation multiple will expand, giving you capital appreciation on top of that 6% dividend. This is the dual benefit of buying top-tier companies when they are temporarily out of favor. I've built my career finding these opportunities. While everyone else chases the latest hot stock, I focus on the overlooked, boring companies that nobody talks about at cocktail parties, because those are the investments that truly generate wealth. These are the kinds of stocks that keep paying you even while everyone else panics over market swings. That's what distinguishes savvy investors from amateurs. Now, if you're still following along and this all makes sense to you, hit that like button right now. Leave a comment below to let me know whether you agree with this pick or if you think I'm completely off my rocker. I want to hear your thoughts. My goal is to build a community of serious investors who understand what it truly takes to create lasting wealth. And if you haven't subscribed yet, what are you waiting for? Subscribe and join this channel. This is the place where we focus on real investing, not speculation. But we're not finished. I promised 2 stocks, and the first one focused on steady income, infrastructure, and dependable, but often overlooked, cash flow. The second stock is a bit different. It's still a high-quality company. It still pays dividends, but it offers much more growth potential. This company is positioned to benefit from massive long-term trends that most investors haven't even noticed yet. The second stock I would buy without hesitation operates in the healthcare sector. And when I say healthcare, I'm not talking about a speculative biotech company betting on a drug in clinical trials. I'm not referring to a hospital network subject to unpredictable government reimbursements. I'm talking about a business that sits at the center of one of the most significant trends of our lifetime: the aging population. Here's a fact many people overlook: every single day, thousands of baby boomers turn 65. This is the largest generation in history, and they are all growing older. As people age, they need more healthcare services, more prescription medications, more medical devices, and more support. This isn't a trend that will reverse. This is demographics. And demographics are destiny. The company I'm referring to operates within a very specific niche in healthcare. This company provides essential products and services that are used throughout the entire healthcare system. Hospitals rely on them. Clinics rely on them. Doctors rely on them. Patients rely on them. And here's the critical point: these products are not optional. They aren't discretionary. When someone undergoes surgery, the hospital doesn't say, maybe we'll use this company's products, or maybe we won't. These products are required, it's part of the standard of care. This gives the company tremendous pricing power. When your products are essential, when switching costs are high, and when quality and reliability matter more than price, you can maintain healthy profit margins. You can raise prices to counter inflation and protect profitability even during economic downturns because healthcare spending is one of the most resilient sectors of the economy. People might postpone buying a new car during a recession, but they don't delay necessary medical treatment. Now, let's look at the financials. This company generates substantial free cash flow. Their return on invested capital is excellent. They maintain a strong balance sheet with manageable debt and have been consistently returning cash to shareholders through dividends and share repurchases for years. The dividend yield is around 3%, which is solid, and it has been steadily growing. While this isn't the 6% yield of the first stock, that's because the market has already recognized the growth potential here. With this healthcare stock, you're getting both income and growth. You earn a decent dividend while waiting for the business to compound over time, and it compounds effortlessly because the underlying drivers are so strong. An aging population means more procedures, more treatments, and increasing demand for the products this company manufactures. This isn't speculation, this is simple arithmetic. Now, let me explain the competitive advantages, because this is what truly makes me excited. First, this company has spent decades cultivating strong relationships with hospitals and healthcare providers. They are far more than a simple vendor, they are a trusted partner. In an industry where people's health and lives are at stake, reliability is far more important than saving a few dollars. Hospitals aren't going to switch suppliers to save 5% if it could compromise patient outcomes. That loyalty, that trust, represents an enormous competitive moat. Second, the company benefits from significant scale advantages. As one of the largest players in its sector, it can negotiate better contracts with suppliers, invest more in research and development, and spread fixed costs across a broader revenue base. Smaller competitors cannot match this efficiency. In healthcare, where profit margins can be thin, operational efficiency directly translates to higher profitability. Third, the company maintains a diverse product portfolio. It isn't reliant on a single product or customer. Multiple revenue streams span various areas of healthcare. If one segment has a weak quarter, other divisions offset it. This diversification reduces risk and ensures stability. And it is that stability that enables the company to pay its dividend reliably year after year. Now, let's discuss valuation. Is this stock cheap? Not exactly. It is fairly valued. The price-to-earnings ratio is reasonable, though not a bargain screaming for attention. And you know what? That's fine with me because sometimes paying a fair price for an exceptional business is worth it. I'd rather own a top-tier company at a fair price than a mediocre business at a discount. Quality matters, and over the long term, quality compounds. After 4 decades of investing, here's what I've learned: my biggest mistakes weren't slightly overpaying for an outstanding company. My largest errors came from buying cheap stocks that appeared inexpensive but were fundamentally flawed. Cheap stocks are usually cheap for a reason. They have problems, weak management, or structural issues. Many companies have dying business models. No matter how low their stock price falls, you still lose money if the company ultimately fails. This healthcare company is not one of those failing businesses. It's a premium, high-quality enterprise with a promising future. And if I need to pay a reasonable multiple to own it, I'm completely fine with that, because I know that 5 or 10 years from now, this company will be worth significantly more than it is today. The growth trajectory is evident. Demographic trends are undeniable. And the management team has demonstrated they know how to execute effectively. Here's what I'm doing personally. I'm building positions in both of these stocks. The energy infrastructure company provides me with high yield and stability, while the healthcare company offers growth and exposure to unstoppable demographic trends. Together, they create a balanced investment strategy. I receive income, I capture growth, and I'm diversified across sectors. This is how you construct a portfolio capable of weathering any storm. Some of you may be thinking, Kevin, what about technology stocks? What about artificial intelligence? Everyone says that's where the big money will be made. Yes, technology offers opportunities. But here's the problem, everyone knows it. Everyone is piling into the same companies. Valuations are stretched, and expectations are sky high. When expectations are that high, it's extremely easy to disappoint. I'm not saying you should avoid technology entirely. I'm saying don't risk your future by putting all your money into it. Don't mortgage your financial security on the hope that some AI company will revolutionize the world. First, build a foundation. Own stable, boring businesses that generate reliable cash flow. Own companies that pay dividends. Own enterprises that will still be thriving 20 years from now, regardless of what happens with the latest tech craze. That's your foundation. Once you've established that, you can start taking calculated risks on growth stocks. But most people do it in reverse. They chase the latest hot stock first. They put all their money into speculative bets. And when those bets fail, they have nothing to fall back on. Their accounts are wiped out, and they have to start over from scratch. That isn't investing, it's gambling. And in gambling, the house always wins. I'm giving you the blueprint here. These two stocks, energy infrastructure and healthcare, form the backbone of a strong portfolio. They won't make you rich overnight, but they will steadily compound your wealth over time. They pay dividends that you can reinvest, and they will remain stable when the market crashes and everyone else is panicking. Let me tell you something, I've experienced multiple market crashes. I've watched my net worth drop by millions in a single day. And you know what? It doesn't faze me anymore because I understand that owning quality businesses means they will recover. Collecting dividends ensures I'm still earning even when stock prices fall. The best time to buy is when fear drives everyone else to sell. That's the mindset you need to develop to succeed in investing. You cannot panic. You cannot sell at the bottom. You must have the discipline to stick to your strategy, even when it feels uncomfortable. The only way to develop that discipline is by owning businesses you genuinely believe in. If you hold high-quality companies with strong fundamentals, you can sleep soundly knowing they will endure. These two stocks I've shared with you today are exactly that type of investment. Owning them allows me to rest easy at night. I understand the businesses I'm investing in. I trust the management teams. I believe in their competitive advantages. I like the valuations, and I love the fact that they pay me dividends while I wait for growth. This is what smart, disciplined investing looks like. Now, I need you to take action. If what I've shared today makes sense to you, if you recognize the value in owning high-quality, dividend-paying companies with strong fundamentals, then it's time to do your own research. Don't just take my word for it. Examine the financial statements. Read the annual reports. Understand what these companies do and why their advantages make them competitive. Become an informed, educated investor. While you're doing that research, hit the subscribe button if you haven't already. Join this channel and become part of something special. We're building a community of serious investors who know that wealth is created slowly, methodically, with patience and discipline. We aren't chasing get-rich-quick schemes. We focus on building real, lasting wealth. Leave a comment below and share your thoughts. Do you agree with these picks? Do you own any dividend-paying stocks in your portfolio? What's your investment strategy? I want to hear from you. I want to know what's working for you and what questions you have. This is a conversation, not a lecture. We're in this together. Here's the truth, the market doesn't care about your feelings. It doesn't care if you're having a bad day or if you need cash immediately. The market moves as it moves. But if you position yourself correctly, if you own the right businesses, and if you follow a disciplined strategy, you can profit regardless of market conditions. You can build wealth in both good times and bad. That's exactly what I've been doing for 40 years. That's what I will continue to do, and that's what I want to teach you to do. So stop wasting time on Reddit forums and Twitter threads, where people are hyping up whatever stock they bought yesterday. Start thinking like a true investor. Focus on the fundamentals. Begin constructing a portfolio that will provide security and growth for you and your family for decades. These two stocks, energy infrastructure and healthcare, are my top picks. These are the companies I would invest in right now without hesitation. Not because they're flashy or likely to double overnight, but because they are solid, reliable, cash-generating businesses built to last. This is exactly the kind of investment you should be seeking. Thank you for watching and thank you for being part of this community. Now, take action, do your research and start building the portfolio that can transform your financial future. Remember, wealth is built one smart, disciplined decision at a time. Make this one of those decisions. Subscribe, join the community, and let's continue this journey together. I'll see you in the next video.